And here we go.
There we go. This is Mike Doyle with the mortgage firm Wellington-LakeWorth, and I'm here again with Elizabeth Lopez and Tom Bennick. It is Friday. It is noon. We are here every week, and it's to answer any of your mortgage-related questions. So it's going to be an open forum, so bring whatever questions you might have. And we're also going to just talk about the Hometown Heroes because it goes into effect July 1st. So a couple changes. I know Elizabeth put out a couple informative type videos on it, so we'll cover some of that stuff today.
Yeah, I have like a lot of people starting to apply. Obviously, I know this is going to be opening to a lot more individuals, so you don't want to miss out on it. It's not limited like it was last year, so make sure you jump on this.
Yeah, it's something you want to look and see if you want to qualify for soon. So if you're looking to start looking into purchasing something, get with us so we can see if you're qualified for the program.
Now, Tom and I have a little bet on this one, Elizabeth. You weren't here last week, so we're going to pull you in on the bet. The first set was $100 million only. It was open to, first responders, law enforcement, medical, educators, and it was gone in 11 months. This one's open up to just about everybody. My over/under, I said, was December 31st. That's when it's going to run out of money, December 31st. Tom is betting heavily. Like he said, he'll buy us the nicest surf and turf, steak dinner, whatever we want, if it runs out beforehand. So he's betting negatively, like it's going to run out early. Where are you on it?
I'm going to go a little bit over that.
Over.
I'm going to say probably February.
All right. I think you guys are both a lot smarter than me because I think I've structured it to where it has to run out on December 31st. That's the only way I win. If it runs out any time beforehand, Tom wins. If it runs out any time afterwards, you win. So
I'll take December 29th, 11:55.
Give me a 3-day span in there. Give me 24 before and 24 after.
There's no red rescission. No rescission. No glory period. No nothing.
I'm gonna go mid-February.
Actually, you know what? I think it might run a little bit over because the last one lasted June 1st till when? Till now, basically.
I think it was July 1st through
you're right.
The beginning of June. So
yeah, and how long is that? Almost a year.
11 months. Yeah, that was about 11 months. I think it was just about 11 months. And I feel like it. And look, they may replenish it. So you know what, Elizabeth, don't think that a replenishment counts. Okay?
I'm going to start looking at the menu starting now because
the first
you're going to take my place.
Once the first 100 million is gone, that's where it is. So I'm hearing a lot of people, and look, good for them. They may be right, but I'm hearing a lot of people talking like this could be gone quickly. I mean, it might be, to get people going because we want people to kind of, at least get ready and be in a spot. So, go ahead and let us get you pre-approved.
Yeah, well, it's a great opportunity. And I think that, although the hype is everybody qualifies if you're a first-time home buyer, there's still a few little things that we need to talk about, which is what we're going to touch base on today. So if you kind of take those things into consideration, and then I don't know about you guys, but like for me, the minute like December comes around, everybody's new thing is new year, new house, and I'm really busy in January. So that's why I'm going to hold on to it until February just to make myself feel better.
Well, you're right. That January, February can tend to be a slow month, but boy, February, right? Everybody gets out there, but February, March is where it really picks up. So I can definitely see, I would be very surprised to see that money lasting through the end of March.
The last, I want to say 4 or 5 years, every January 1st, I either have Anthony pulled up to the side of the road and I'm on my computer if we're away, or I'm doing a pre-approval and I have a contract coming in, and I'm not going to jinx myself, but it happens every January for me, every January 1st. So that's how I kick off my year.
That's a good way to start the new year.
Yeah. Now, Tom, we're going to let you talk about, because you have one going right now. I'm going to pull this in because we just had this guideline up right now. This is also the Florida housing site. And I don't know if you can see right there, that first sentence.
So one of the requirements that was made with the new program coming out July 1st or July 3rd funding is the borrower must work 35 hours per week. So if you're in any field, whether it be medical, whatever field you're in, if you're a wage earner, of course, they stipulate the amount of hours that's worked on your paycheck stubs. that's got to calculate at 35 hours a week or more, regardless of employment, type of employment, program, no program. Apparently, that's what they're considering a very hard stop, in other words. So, uh, and I know in the medical field, sometimes, full time may not be considered 40 hours. Sometimes full time might be considered 34, 32. It varies with that industry. But yes, that is one of the important factors of the new program. It's got to be 35 hours a week or more.
Yeah, 4/8. If you work 4/8, that's $32 an hour. We run into people that are in the medical industry. You could be making some good money. You're making $50 an hour. I've seen 50, 60, $70 an hour, and you're working 4/8, and you're making good money. We just did a loan for somebody who was working, I think, 32 hours, very good pay.
Sure.
And we had no problems with it, but luckily it wasn't Hometown Heroes.
Yeah.
Now, Elizabeth, you spoke about self-employed, though. You had a comment about self-employed.
I was just going to say self-employed is another one that we have to be able to track how many hours you're working. Now, I mean, even with us, I mean, I know my gosh, I know that I'm sometimes I'm working over 40 hours a week, and I don't track that, and I started doing some research, and I'll post it to the link to the bottom of this video, but self-employed also has to be able to show that you're working 35 hours or more. So there are apps. I will tell everybody right now, there's apps out there that you could track. You're clocking in, clocking out. I've given people the idea, put it on your invoice. If a job takes you a certain amount of time, we have to have a way in order for you to be able to track your hours and show that you're working 35 hours or more, even if you are self-employed.
I know I've said this just kind of talking, but if you're self-employed, you're working out mentally, you're thinking, you're planning. There's a million things you're doing that are getting you over 35 hours a week. So even if you're meeting customers for 10 hours, you're doing something else 10 hours, there's no way you're not game planning, thinking, and everything. I mean, it obsesses usually that's going to assess your time. Any type of job where, you're 100% commissions or, and self-employed, where it's entirely what you do, it's consuming you. So I tell you what, I'm going to be hard pressed to believe that we're not going to find a way to show self-employed individuals as working 35 hours a week. Now, we might have to think through some of it, and we have to find ways that are acceptable by Hometown Heroes. That's really the key, is we have to find ways that are acceptable to Hometown Heroes. Now, Elizabeth, you had another point too in one of your information things that about local versus out-of-state companies.
Yeah. So the local company. So the biggest misconception is that if you're working, for example, large companies such as, I'll use Walmart as an example. If you're working for Walmart and the headquarters are out in Texas, for example, if you're living in Florida and you're, let's say you're HR, you're working from home, you're HR employed by Walmart, but you're reporting to the headquarters in Texas, that doesn't qualify you. But if you're working for Walmart and your Walmart location is in West Palm Beach, Florida, then you're okay. So it's not just where the headquarters is where are you reporting? Like I think that's pretty much the best way to explain it, is where are you reporting? If you're physically going into a location, brick and mortar location, that's here in Florida, you're fine. But I know that there's a lot of questions around that. If you're working for Florida, or you're working for Walmart, there's Walmarts here, but I work for HR, I'm reporting to Texas, then I don't qualify for it. So just let us know exactly where you report. And the main thing is that when we're filling out the application, or whenever you fill out an application for us, on the link that we send, make sure that on the application that 1003 reads the place where you are reporting to.
Now, I want to double back a little on that self-employed, because one of the things that's, self-employed bars may provide a copy of work schedule provided by a third party indicating 35 hours a week or more, or a copy of a pay stub. Now, I do love, if you have an S corp, or if you're self-employed, and you give yourself a W-2 also. So a lot of times we'll work with self-employed individuals, and they'll pay themselves whatever, $35,000, $40,000 as a manager fee, and then they'll take distributions of whatever. But at least that way it shows out you have an hourly paid. Maybe you're paying yourself, for 40 hours a week, but it shows something. So third party looks like you could probably get a CPA letter. So I just believe that, it's a matter of us digging into it and finding, certain ways to document it. But for self-employed individuals, we're going to find ways to be able to document that.
Yeah, that would be a good option if you can get a letter from either a CPA notice or whatever the other third-party options might be.
Yeah. A couple things that haven't changed: 640 minimum credit score. You know, I see people advertising a lot. Oh, we can do 500, we can do 580, we can do about what anybody else can do. But you know what? If you have to move now, sometimes there's certain things you have to do. But there's a lot of things we can do as far as just building credit. So it's always frustrating to me when I watch one of our competitors that's, oh yeah, we can do this, we can do this. You know, if we can get you build credit and we can hold you off for a couple of months, it can make all the difference in the world. It can make all the difference in the world. The 640, we get you from a 620 to a 640, and now you're going to get 20, 30, $1,000 that can help you towards your down payment, prepays, and closing costs. And not just that, you're getting a better interest rate, you're getting no discount points, and you're getting reduced closing costs. So yeah, is 580 there? Why is it a 580? If I think that somebody could have paid down some credit cards, gotten up to a 640 and gotten a great loan, but somebody put them into a 580 type loan, that's just not the way to go.
Yeah. I'm not a fan of the way that those are promoted either. I mean, if have I done them to where they're very low? Yes. I just always feel like I'm not doing anybody any favors, but there's ways for us to be able to see if there's improvement on credit and obviously give you better options.
Yeah. Let's say real quick, debt to income ratios. So debt to income ratios under Hometown Heroes, they can't be over 50%. So if you're FHA, VA, sometimes you can go up to 55, 57%. Now that's your total ratio. That's your housing payment plus everything else, your car, your student loan, your credit card, your boat, your planes, everything. So Hometown Heroes doesn't let you go over 50%. Now, regular, like I said, if we go up to 55, 57%, that's a lot. And we look at the front end ratio too, which is your housing payment. When you start getting up over 40, 42, sometimes I've seen some approvals up 44, 45% of your housing ratio. That means that over 50% of your take home money is going towards your house. Now, let's say you have money or you have a raise we can't use, or there's money that you have coming in that we can't use, or you have a spouse or somebody else that has money coming in that we can't use. I'm okay with that. That's fine. But if I'm dealing with a single parent with a couple kids and we're taking over 50% of their money for their housing payment, those are conversations we want to have with you. So we want to make sure that we're improving your life, by buying this house, and that you're happy with the service we provided after you buy the house, and not that we've just sold you a house. Our goal is we want you to tell everybody about us, refer us to everybody because you were so happy how we took care of you. Now, co-signers and income, interesting one. We're running into this right now is co-signers are allowed with FHA and Fannie Mae on the Hometown Heroes, but they have to be non-occupant co-borrowers. So the co-signer's income is included in the credit qualifying income. The income used to support the AUS income must be considered in the income used to determine the buyer qualifies for the program. So, but if you're going to be living in that house with the person as a co-signer, we're counting that income, and you also need to be a first-time home buyers.
So I want to kind of define what a non-occupying co-borrower is real quick. It's, of course, somebody that's going to help you purchase the property. We're going to use their income. We're going to use their credit to help you qualify, but they're not living in the property. They have their own primary resident. That's why it's considered a non-occupying co-borrower. They're not occupying the same property. They have their own property they live in. A co-signer lives with you.
Right. And the non-occupant co-borrower also is whatever their housing expense has to be, it counts against the loan as well.
Correct.
So if they're paying like a $2,000 a month rent or $2,500 a month rent, we have to include that as a housing expense towards that.
Yeah. Now, I will say what's of interest though, the bond loans, bond only counts people that are living in the house. So bond only counts those that are living in the house. So if you have a non-occupant co-borrower, and the non-occupant co-borrower is making $100,000 a year, and the bond person is making under the bond limits, they can't qualify for bond money. So that's where bond could potentially be good. Now, bond also for FHA, bond rates have been pricing up pretty well. They've been pricing up better than Hometown Heroes rates. So we want to make sure that we're just not sticking everybody into Hometown Heroes when for some applications, the bond. Now the bond's going to max out at $10,000, but that's equivalent to a $200,000, purchase. You get the maximum amount. But bond is also, it can be a really good program in the right spots.
Yeah, there's all kinds of programs that fall under the bond, whether it be Heroes, whatever they are. So when we're discussing bond loans, it's just a category of other loans that are available.
Mm-hmm. The other thing also, when you're getting like that cash back or seller concessions, I've gotten this question quite a few times. Just because you're doing Hometown Heroes and there is a seller concession, you could still get it. It's not just because you're doing Hometown Heroes, that doesn't count towards the 6% or whatever seller concession, depending on what type of loan you're doing. That's in addition to.
That's a good point, because that's what gets you into the house with 2.5%, 3% all in.
Right. So when you hear like that, we have programs that will get you into that 1%. It's not a specific program that gets you into that 1%. It's the 1% with Hometown Heroes, 1% with the seller concession, and then you just had to come out of pocket 1%. So it's not a special 1% program.
It's really the structuring of the deal altogether that gets you that 1%.
Right.
It's a small print.
Why don't you explain first-time home buyer?
Me? You want me to explain a first-time home buyer?
Yeah, I hear you talking about it a lot.
Sure. A first-time home buyer is somebody that hasn't been on title to a primary resident in the past 3 years. So you could have owned an investment property and be a renter and still qualify to be a first-time home buyer. So as long as you have not been on title to a primary residence over the past 36 months, you are going to be considered a first-time home buyer.
Now we got a question from Rob. Rob says, what if I'm in the middle of a contract and they run out of money?
Well, that's a good hypothetical question. I would assume, and I'm only guessing, that if your contract, what I've noticed in the past is if a borrower has a property and that loan is locked, that rate is locked, then they'll most likely fund your loan. Usually when this happens, like when they said that they're running out of money for the current bond, I think they had a stipulation that if your loan is locked and submitted, then you'll get funded. But if you're still in the pre-qualification or you don't have a property or your loan isn't locked yet, I think you might run the risk of not funding under that loan. That's only an assumption on my end. Please don't.
No, we reserve the money. So we reserve the money. So once we reserve the money's reserved.
And that money gets reserved when you lock the loan, I believe.
Yeah. So we lock in reserve. Now, the only thing is, from when we do it, we got to deliver within 60 days. So which means that we don't want, we've got to close the loan and then get everything in there satisfying, Florida housing. So we don't really want to be locking everything, like to have it 45, 50 days, at the most. So if you're out there doing 90-day contracts or something like that, or, there's other types of delays, because we run into stuff where now somebody's working on fixing this, or they're working on a roof, or with all kinds of different delays, you could run into a problem. I would say that we want to, right now it hasn't been such a big deal because we know the money's been there. But as time starts running out, we want to get that reserved as soon as possible. So I know Tom, who says that we're going to run out quickly, will probably start reserving really fast. Now Elizabeth, who says we're probably going to be good through, March, April, May.
I'm a neurotic personality, dude. I'm telling you, I'm neurotic with just about everything. So yeah, my thoughts is if you're looking, then get on and get qualified quick. I'd rather be safe than sorry. I do want to go back to your first timer. So veterans do not need to be first time home buyers. So just to pick up on that first time home buyer requirement, it's not required for a veteran. You could supply your DD 214 or your certificate of eligibility. You don't need to be a first timer.
Now, the nice thing on veterans is it's truly a no money down. For the most part, a no money down is you get 100% financing if you're a veteran, and then you get 5%. So if you're doing a $500,000 loan or a $500,000 purchase, you get the $500,000 for the purchase, plus you get another $25,000 to help you with your down payment, prepays, and closing costs. Now, one of the things, if you're a veteran, I would want you to do is especially if it's the second time you purchase. If it's the second time you purchase, you get a big upfront funding fee. So the funding fee that gets rolled into the loan is substantial if it's up over 3%. So if you can put 5% down, you can reduce that considerably and save yourself a lot of money. So you might want to think, maybe if you have the ability to put 5% down, put the 5% down and save yourself a fortune in that upfront funding.
Yeah, and please, if you are considering doing a VA loan, send us your DD 214 or your certificate of eligibility. I experienced where I noticed that somebody was actually exempt from that funding fee. Some veterans are exempt from that and may not be aware of it. So, yeah, if you send us your certificate of eligibility, let us read through it, please. Property types.
Sorry, I was going to say the VA loans are so awesome to do with these. I love doing the HomeTown Heroes with the VAs because it's just awesome how they just come out of pocket just for the appraisal and the inspection, which are two items that you pay up front. So that can't be rolled over. So I wanted to make sure that was told. But the fact that that's just the only thing with just less than $1,000 to be able to move into a property, that's pretty awesome.
Yeah, it certainly beats what you're going to have to do to get into a rental.
Mm-hmm.
We know even with the places that are going up across the street from our building, the rent is just not only expensive to get in there is ridiculous. And I think they're qualifying to rent is harder than qualifying for a mortgage.
Yeah.
Yeah.
They're gotten very, very strict.
They're asking for 700 credit scores plus. They're asking for all kinds of nonsense. So
yeah, rent is actually, a lot of them are actually doing three times the monthly payment. So if the rent is $3,000 a month, you got to show that you make $9,000 a month income.
It's crazy.
That's insane. So if you're in that situation, you need to be applying for a mortgage.
And yet people will somewhat be concerned with what today's interest rates are, but yet they won't have too much of a thought as far as putting that money into a rental.
Yeah.
I'm not quite sure. I'm pretty sure one will probably make you more money in the long run, probably the home ownership. So renting is getting to be very expensive.
This is of interest too. Attached, detached, 1-unit dwelling includes townhomes, 2 to 4 unit properties. So you could buy a quadruplex. So you can do an FHA loan, 3.5% down, quadruplex, and get your down payment and get help with your down payment, closing costs, and prepaid.
Mm-hmm.
Now, I know I love this thing, but they're just hard to find. It's one of those things that's so much easier said than done. Is quadruplexes, duplexes, triplex for first-time home buyers. Such a great thing to do. It's just they're so hard to find. So I'm always wanting to find a builder because I know if a builder could get out there and just start building them, I could go ahead and finance as many as they could build, because I know every first-time home buyer would love to at least have a duplex where they're living on one side and renting out the other. It's just they're very hard.
I wanted to point out also why on the 2 units, if you have a property that, because I ran into this, and if you have a property that has a mother-in-law or it has an apartment type thing, some of them have like the garage. This one, the one that I had was a garage downstairs, apartment upstairs. That on the property appraisers, it reads as single family, not as a multifamily. So we would not be able to use it's considered a single family. So it's not a 2-unit property.
It's a great point.
Thank you.
If it's got the same folio number, smarty pants.
Just telling you the right answer, Thomas.
No wonder why you're
He's not Mean Girl Monday, Tom, okay?
No wonder,
Mean Girl Monday.
No wonder why you're the favorite.
Now, this is something of interest, though, too, is, because I am running into this right now. If you're a non-borrowing occupant, non-occupant borrower, okay, so you're just signing, you sign the non-borrowing occupant, non-borrowing. All right, co-signers, that's not going to be so much, but I'm sorry, it's the co-signer signs the note, doesn't sign the mortgage, does not sign program documents, appears on deed, does not appear on deed. And they're pretty clear. You don't get a buy and then throw somebody on the deed afterwards. So Hometown Heroes is pretty big on that. You're not throwing something on the deed afterwards, because when that becomes investment property, you change the terms, your money is owed back. All right. So resides in the home, no. Included in program qualifying income, yes. We have one right now where it's a borrower and a non-occupant co-borrower. We throw both their money together. They're going to buy, and the co-borrower cannot be anywhere on title, deed, or anything like that while they have the Hometown Heroes loan. So that's something of interest.
I got to print that one out.
Yeah. Now, I also want to say one thing too, because Hometown Heroes, again, I say is, I like the loan. We do a lot of them, but there are a few things you need to be cautious of. Any financial planner is going to say, if someone gives you $20,000 now, no interest, no payments, sometime in the future, they want to pay the $20,000 back, they're going to tell you to do it. So the only thing though that's tough is if you're taking that $20,000 and you're putting it all into the equity of your house and you don't have any money. So you come to closing, you have no money. Well, no crystal ball here, but it is projected that the rate should be trending down. So sometime in the next so many years, you should be refinancing out and getting a better loan is the hope. Well, when that time period comes, if you don't have the money to pay back, then you can't take advantage of the greater rates. So if you had, for example, a 6.5 rate, and let's say sometime in the future they went down to 4.5, and you had a $400,000 loan, you're dropping 2 percentage points. And if your loan's $400,000, that's $8,000 you're going to save right off the bat. So if you don't have, the whatever you got from the $25,000 to give back, you can't take advantage of the huge potential savings that you're going to get on the refi. Mm-hmm. So I would say to people, I love it when you have some money, but you use the government's money instead. So I'd love to see someone who's going to take that take $10,000 and put it in an I bond at 6.5, and put another $10,000 in, whatever their investment thing is at, 4.5, and just know that that money's going to have to go back in a year or 2 years or 3 years. And then when you give that money back, you at least have some interest. But just kind of have that in your mind that you've got to give that money back when you refinance, when you sell, or when you convert it to an investment property.
The other thing I think is, and correct me if I'm wrong, and I could be, if you're going to be trying to take advantage of the lower rates in the future, if that does happen, you would be considered a cash out refinance in lieu of a rate and term, because you're paying off your second, correct?
If you're paying off, if you do the second at the time of the first, so if you do a first and a second at the time of the first, and all you're doing is paying off the first and the second, it should be allowed as a rate and term refi. So if you have enough equity in the house that you've gained enough equity at the time of the refi, you could pay both those off.
That's a good point.
That you could get, if you get a 5% appreciation, then you have to absorb the closing cost prepaid escrows. You could be able to do that, but I would be kind of like to see people plan on having some of the money though too. Mm-hmm. Now, when somebody says to me, I don't want to have to worry about giving the money back, my answer is, you've got the money. You've got the $20,000 or the $20,000 you were going to give. Instead of giving the $20,000, take the government's $20,000, put your money in investments, mm-hmm. and get the lower interest rate and the lower closing costs too. So take your $20,000 invested, take the government's money that's not costing you anything, take the lower interest rate loan and the lower closing cost loan. And don't worry that Mike Doyle's is making a lot less money on this loan, because I know Elizabeth and Tom. And he's
all the things. Great, they're great. I wanted to point out, if you could just go scroll up a little bit. The fees that brokers are allowed to charge on there. Like this came up as a surprise a few times last year with Hometown Heroes. It just can't exceed $400. So it's not something that the mortgage firm said, I don't want you to charge more than, I don't forget your $500 fee or $475 or whatever. I've seen so many fees out there, but it's just, this is part of the cost, the fees that were allowed through Hometown Heroes to be able to charge. So make sure that if you let your broker know. And I just hate that it came up a couple of times last year, surprise at closing, and just know it's not from us.
Right. We're not trying to take money out of the realtor's pockets. That's for sure.
No.
No, as a matter of fact, on all of these programs, all of the fees are dictated to us. Basically, whatever the charges are either third party, which means they're not in our control, and or they're dictated or told to us what they need to be.
Mm-hmm.
And just real quick, because I know we're running out of time here, but income, Palm Beach County, 146,100. So that's your income limit, 146,100. That's pretty solid. You know?
Mm-hmm.
So we're pretty much at the top. I think Dade County, Miami-Dade, 154. A little bit higher.
Monroe's 162.7. That's up there.
Look at that, Monroe. That's down in the Keys, though. That's so we got Miami-Dade, 154, Monroe, 162. So that's pretty good stuff right there. That's wonderful.
I was just in Key Largo recently, actually for Father's Day weekend. We took Anthony down there, and there's a lot of new builds going up down there. I was pretty surprised. So
New stuff?
Yeah, new stuff going on.
Condominium stuff or low, like 2 and 4 stories?
Little bit of everything.
Wow.
Bit of everything. So, and believe it or not, duplexes, Mike. So imagine having like a nice duplex over there.
Wow.
Whereabouts, Elizabeth?
In the Keys.
On the Keys. Yeah.
Yeah.
That would be a great place for the mortgage firm to hold regular meetings. I think we should look at that. It's a great opportunity.
Elizabeth, you buy the duplex down there, we'll come down there. We'll rent it for
an hour and a half trip.
All right, and quickly too, FHA loans, HomeTown is up to 557, 750, and conventional loans up to 726,200. So, anyways, all right. What else? I'm going to say we're going to do a big announcement. We've got Dorothy Jacks with the Palm Beach County Property Appraiser's Office, and she is heavily decorated, recognized as one of the absolute top property appraisers, and their site, Papa, is phenomenal. She has won all kinds of awards, but she's going to be coming and speaking to us on August 2nd. So we'll go ahead and we'll send some invites out, but you definitely want to be there. I want to have it at that time because it's going to be a little bit before the trim notices come out, before you start seeing what your taxes are going to be, your property taxes. And we're also going to start talking about portability, market value, and things like that. So, we're going to really open this up to all of the realtors we work with and any of the customers that we're working that are pre-approved or just bought. So any of those individuals, you got to be a little bit curious. Where are your property taxes going to end up? Anybody's looking at selling, that market value truly affects your portability. So you want to know, what you're looking at, what you set yourself up with right now could really have thousands of dollars of impact on your annual property taxes at your next place for as long as you're there.
She also does a great explanation on homestead exemption, the benefits of it, how to apply for it. So yes, if you're considering purchase anything, it would be great to just learn on the Florida taxes, the homestead exemption, and everything else she's going to tell us about.
For sure. Then as always, just make sure that you like our page. You're here to find all this information on the Lakeworth or Wellington Lakeworth page on the mortgage firm. Go to Facebook, like us, share us, join us for so many activities that we have. And then, so tonight, 6:30 class tonight.
Yep, 6:30 class, tmfclasses.com.
I'll be doing a 6:30 class live presentation at PR Bakery. I go there also for their goods because it's delicious, but but you could join us. So many ways to get information, but we'll be here to help you guys.
Elizabeth, in person, PR Bakery, incredible bakery at 6:30 tonight on Lakeworth Road. So, all right, guys, thanks for joining, everybody.
Thank you.
Bye.